Hello all, I hope you're having a wonderful day. In this video, I'm going to talk about covered calls and get more in depth on some of the topics that I've been talking about in prior videos. So let's go over it. First of all, why do you want to do a covered call? First of all, you want to hold the asset long term, but you're okay to sell it if for big monthly gains. You want to generate a steady income, and you want to limit your losses and protect your holdings. So the requirements in order to do a covered call is you need to own a minimum of 100 shares. You need to have an options account, and it's best to do in a tax advantage account like an IRA or even better, a Roth IRA. Some of the things that I've learned over the years is that picking volatile stocks typically have higher implied volatility will increase your option premiums. And we'll show you some of that in the next couple tabs. Stocks that pay a dividend or that are low volatilities don't provide really great premiums, and sometimes it's kind of a waste to even do a covered call against. And then also, while you're doing this against volatile stocks, you need to prepare yourself to have your options assigned, meaning that you're going to end up selling your shares. And of course, if that happens, and I'm going to show you the example, it's not the worst thing in the world, but it is something you need to prepare yourself for. Also, with covered calls, you do limit your upside. So if a stock that you own that you really love and truly been following, and it gets assigned, and you see it go up really high, you might kick yourself. So something that you need to prepare yourself as well is that you need to be willing to let go of those shares if they go up really, really high. Again, if you're not in a tax advantage account, you're going to have to keep track of everything, all the transactions, and you will end up having to pay capital gains tax on against that. So some of the things that I've learned over the years. My method is pretty straightforward. I like to do monthly calls so that I can generate a monthly income. I also, in order to select the right strike price, I use the Greek. It's called the Greek is called delta, and the where I find is a pretty good sweet spot is the 20 delta within a month. And some people consider a delta as kind of like the likelihood that that stock will hit that strike price in that time frame. So in this case, it would be you have like a 20% likelihood that it's going to hit that strike price. And I like to do this against volatile stocks um, because I can collect a pretty juicy premium against it. And then some of the things that I'm not going to talk about, but I will talk about maybe in future videos if you're interested, is talking about the wheel strategy. And then when you do end up selling those stocks, you can generate a lot of cash, how you can actually make money against that cash by selling puts against your cash reserves. So if you're interested in hearing more about that, put something in the comment and I'll build a video against it. So I'm going to walk you through three different scenarios when you're doing covered calls that can happen. Basically, one is that I call it the below, which is that the price when you start the covered call ends up below what the price that you started it at. And then above is when the actual price of the stock goes above the strike price. And then what I call the perfect covered call is when the price ends up at the end of the month in between the price where you started and below the strike price. So I'm going to show you the visuals to kind of walk you through that. So the first one, let's look at the below. So as you can see here on January 21st, 2025, this is actually a call that I did with IBIT, a covered call, I call it the monthly example, and the price ended up going below the strike and actually below the price that I started with. So as you can see, I started on January 21st. The price of IBIT was $60.48, and I sold a call, one call against this for a strike price at 72. So that's what the delta was. Delta 20 was at 72. So even before I started going to the right here and seeing what the price of the stock was, you could see that I had put in my pocket right when I sold this call. I put in my pocket a dividend of $1.16 per share. That's a yield of 1.92% within a month. So making a 1% yield or almost a 2% yield in a month is really awesome. And you multiply that by 12 months, that's anywhere from 12 to 24% return on your that you're just pocketing. So as you can see, and then worst case scenario, which I'm going to walk through the next scenario where this actually happened. If it went all the way up to 72, I still would have made an additional 19% or $11.52 a share. So almost 20%, over 20% I would have made if I had to get my call got assigned. I still would have made 20% within a month, which is just awesome percentage wise. So let's walk through what actually happened. So you can see the price. This is the blue line, shows you the price and where it ended up. And so it actually ended up at $50, $56.04. So it dropped from 60 down to 56. So I still held the stock. I still owned it, but I had an unrealized, unless I sold it, I still unrealized loss of 7%, which is not good. But if I would have just bought this stock and held it and didn't do this covered call, I'd still be down 7%. But because of this yield that I generated, I'm not down 7%. So it's almost 2%. I'm really down like 5%. So I've dollar cost average my average cost of this stock by an additional 2%. And over the year, that's going to get lower and lower and lower. So I'm dollar cost averaging out every month, which is really a side benefit that you get from a covered call. So that's the below example. The next month, or a couple months later, and I want to give you another example, is on April 9th, 2025. The IBIT was at $44.13. I sold a call at $51, which is what the delta was. And as you can see, when I first started, I have built in, I put in my pocket right when I saw this call, 75 cents. So a yield of 1.7% yield. And if the stock went up, which in this case it did, I got an additional 15% yield or $6.87 per share. So a total of, say, 17% within a month, which is nothing to shake a stick at. That's pretty good. Making 17% on your investment within a month is crazy good. That's because this is a very volatile stock, as I started talking about earlier in this episode. But the downside, which this is the part you need to prepare yourself for, because this is a volatile stock, it ended up going all the way up to $57. And so I lost the upside of $6 or additional 15%. So I ended up having to sell all my shares at $51. I collected, 17%, and now I'm in cash, right? So I can either buy back or I could do the wheel strategy, which I was talking about later on. But just to suffice it to say, this is not the greatest thing in the world, but it's not the worst thing in the world. You still made a whole bunch of money, and there's a lot of other stocks out there that you can buy and sell and do the same thing against. And then lastly, I'll leave you with what you really want to try to get to is called the perfect covered call. And this is actually against Nvidia, which a lot of people have been following that know that it's a very volatile stock as well recently with the whole AI craze. So at the time on April 8th, I ended up executing this call when it was at $102.78. And I sold a call. The strike price at the 20 delta was 119. So right off the bat, I put in my pocket an additional $1.59 or 1.5% yield within that month put that in my pocket, and then I sit back and wait. And as you can see, the stock went in the sweet zone for a while, actually dropped out, and then ended up at 117.37. So even though I still own the stock and I didn't sell the stock, but the unrealized gain was an additional 14%. And this is actually a perfect scenario that you want to get to. So over the years, I've been doing this and noticed that I'm about an 80-20% of the time, about just like the 20 delta, about 80% of the time, I'm getting into a perfect or a below scenario. And in those cases, I still own the stock. And then about 20% of the time, I end up having to sell the stock, get it assigned. But again, this is not a bad thing. Getting your call assigned means that you're going to make a juicy amount of percentages within a month when you do this against volatile stocks. So I hope that explains covered calls a little bit better. I know it took me years to really understand the power of this tool, but it's something that I wanted to share with my friends and family. So I hope you have a wonderful day and talk to you soon.